Okay, so the goal of tonight is to show you options trading ideas and the options analyzer pro. Okay, which we already introduced last week, last time when I wanted to show you how to go into more details about the chances presented by the options stream report when you want to know whether what could appear to be a strange movement could be actually something completely normal, or to the contrary, could actually be something worth of being inspected in more details. Because, you know, when thousands of options are traded on Tesla or Amazon or Facebook or McDonald's or Johnson & Johnson, you know, all the big companies, it's just trading. When thousands of options are negotiated on some stocks nobody knows, it very likely means that somebody is taking a huge position, knowing something that very likely we don't know yet. So that could be seen as a strange movement worthy of attention. So last time I showed you how you can take advantage of the options overview report, which you find in the options analyzer pro section. So I already introduced the options analyzer pro section. So let's start with options trading ideas. The goal of options trading ideas is to provide algorithms to the users to scan the markets, because, you know, in the American markets, there are more than 5,000 optionable underlyings putting together stocks and ETFs. So every day the trader is facing a real challenge in trying to, you know, to try and find the best trading opportunities every time. So the platform provides some pre-coded algorithms helping the trader to create lists of underlyings worthy of attention. So this is how the options trading ideas shows like when you open it. You can pick any symbol of your preference and click search, and then you will get to some kind of analysis. Let me pick some stock we all of us know, like Tesla. So you pick a symbol of your preference, you click search, and you get to this window full of information, which I will try and describe very quickly. First of all, you see there are lots of bars having colors ranging from deep red to deep green. Up here in the top right corner, you have a legend, which explains that the red color is for the very strong underperform, and the dark green is for strong outperform, and all the other colors are in between strongly negative and strongly positive. Okay, so the first set of columns here shows the past performance of the stock in question or the ETF. You could pick any ETF of your preference, just to say, and the future expected trend based on the probabilistic models included in the platform. And then you have the option sentiment rate, which takes into account the volatility, the implied volatility of options, and basically the logic behind the coloring, the colors that are assigned to the bars, ranging from 2 weeks to 1 month, 3 months, and 4 months in the future, depends on the ratio between the implied volatility of puts in respect to the implied volatility of calls. Basically, when the implied volatility of puts is higher than the implied volatility of calls, there is either a higher demand of puts for protective purposes or a higher fear of potential crashes in the market. So either way, the expectation or the fears are for a negative movement, and that's why the bar is red. To the contrary, when the implied volatility of calls is higher than the implied volatility of puts, there is either a better expectation, an expectation for an uptrend, or the expectation that the market could be trending up. So either way, the reading of the expected trend is positive, and the bars are green. The same applies in terms of volume. Here, the analysis is a little bit more complicated because it takes into account both the traded volume, both the open interest, and the extended open interest ratio, which takes into account not only the number of contracts open, but also the average prices they have been traded for. So it's a sophisticated algorithm that takes into account these three features of the options. Regarding the past, the analysis of the past trend of the stock, it is not just today's closing minus the closing 3 months ago divided by the closing 3 months ago. It's not just an analysis of the return in the price. It's again a sophisticated algorithm that tries to describe the behavior of the stock over the time window selected, 3 months, 1 month, 2 weeks, taking into account the path followed by the price and not only the first and the last point. Okay, so it's an algorithm that tries to give a better analysis of the past trend. Then down here you have, if there are any, because sometimes down here it's empty, you have some proposals for some trades that might be interesting or at least worth inspecting in full details in order to try and understand whether it could be reasonable or not to try and take some trades on the selected stock. But unless you have a stock of your preference and you want to look for the algorithms pre-coded in the platform, here you have a list of algorithms, a quick look on all of them. Earnings Idea looks for potentially interesting trades on stocks that are about to release earnings. Expensive and cheap options look for stocks on which the options have implied volatilities which are at least in the 80th percentile or below the 20th percentile. So the implied volatility is high or low in respect to, if I'm not mistaken, the last 100 observations, and in both cases, high or low. Overpriced or underpriced options, which could seem something equal to the expensive and cheap, actually follow a different logic. The overpriced options are those options on which the implied volatility is higher than the historical volatility of the underlying, and vice versa. The underpriced options are the options having an implied volatility lower than the historical volatility of the underlying. Then we have overbought and oversold stocks. Oversold stocks are let's pick the first one, which I don't even know what it is, but just to make an example, oversold stocks are stocks or ETFs which have been trending significantly down over the last 2 weeks, 1 month, and 3 months, and which are expected to trend up or at least sideways in the next 2 weeks, 1 month, 3 months, and 4 months. So these are all stocks and ETFs on which you might take into consideration ideas such as naked put sellings or put credit spreads or some other strategies aiming to reach a gain if the stock doesn't keep going down. Okay. About the future trend, there are 6 models taken into consideration, and they are the same 6 models we already know because we described them in the previous live seminar a couple of weeks ago, last week, I don't remember exactly. So you should already know what these models are about, and if you don't, I strongly suggest you to go watch the previous live seminar, because in that seminar I explained all the models, all the probabilistic models used by the platform, where they come from, and what are the goals, what are the pros and cons, what are the things you have to be aware of in order to try and properly understand and interpret and use the probabilistic readings provided by the platform. Then you have a lot of buttons here. Here you have, sorry, everywhere you over the cursor, something shows, some pop-ups show. So here you have a list of all the stocks acting in the same sector and industry as the one highlighted here. Here you have the earnings detail report, which we already saw in the previous live seminar, you remember, for all the periods of the announcing of the earnings, the expected value of the earning, the actual value announced the rate of surprise and the price movement the next day. Then here, you remember we already saw the trajectory chart in order to try and explain what the earning probability is. I didn't tell you anything about this in the previous seminar. This is it's the chart showing the compared performance of the selected stock in respect to its sector and industry as of some date, which now is January the 3rd, 2023, but you can change the date. If you want to make the comparison chart start from a different date, you can customize the starting date here. And you could also decide, I want to compare ASR with another company belonging to the same sector or industry. You just type the symbol here, you press return, and then you will have the other chart shown on the same graph. Okay. Then what else? Okay, here we have another set of charts. We have the chart of the stock, the historical chart of the stock over the last 6 years, more or less. The lines are describing the historical and implied volatility, and below we have the percentiles of the implied and the historical volatility. So this helps you understand whether the current values in the volatilities are relatively high or low, because for some stocks, having a 50% implied volatility could mean there's something huge coming. With other companies, especially the biotechs, the pharmaceuticals, the technological, a 50% implied volatility is a very normal value. So, it's always to be seen in relative terms, and that's what the percentile analysis is for. So this is it. Lots of underlines highlighted thanks to these pre-coded algorithms. So you pick one, I don't know, earning ideas, and you say, okay, which stocks am I interested in? This is the week, mostly the month of the banks. You see, we have JP Morgan's, we have Goldman Sachs, Interactive Brokers, we have Citigroup, Bank of New York Mellon, but we also have PepsiCo Foods, Conagra Brands, Helen of Troy. Helen of Troy in particular is a stock I am following these days because it's very often highlighted by the algorithms of the platform. So I am trying to understand whether there could be some interesting trades to take. For instance, you see here we have a short put, expiration July the 19th, the strike is 80. The credit expected, the maximum profit is the credit, which, by the way, is calculated hitting the bid side of the book. And for the credit and even the debit spreads, sometimes you also have debit spreads or iron condors. They are always made hitting the bid side when you sell and the ask side when you buy. So this is a very precautionary calculation of the expected profit. Anyway, 0.95 is the bid price of the put 80 as of, I have to move away this, okay. As of today, it's the closing because, at this time the market is closed because tomorrow is holiday and today the market closed at 1 p.m. East Coast time. So it's 7 p.m. our time here in Europe, so the market is closed now. As of closing of today, the bid price of the put 80 was 0.95. The success rate is 94, and if we go inspect the different readings according to all the models, they are very similar, which is particularly good. If you remember what I told you last time, the philosophy of the platform is that there is no perfect model. They are all models, all trying to describe reality at best, in the best way it is possible. Sometimes they are right, sometimes they're wrong. So it is pointless to try and decide which model is the best. It is much better when they all say more or less the same thing. As it happens here, you see 94, 99, 92, 96, 93, 97, they all say more or less the same thing. which doesn't mean that the option is risk-free, the trade is risk-free, of course, but the probability of success is significantly high. And the expected profit and loss is 0.63, okay? So we received a few emails during the last few days by people saying, I'm sorry, I will not be able to attend the next live seminar, but if you could reply to some questions during the next, so that I can, watch the registration in the next few days and know the answer. Okay, so let's start with one of the questions that I think it's more interesting. Which trades do you prefer to take when you have long lists, like in this case here? Okay, okay. First of all, I am not very fond of iron condors on stocks that are about to release earnings, because I find it very, in my experience, it is very hard, very rare to not be hit on at least one of the two sides, because when earnings announcement come into play, there's a strong volatility in the price, and it often happens you get hit at least on one side. And the problem is that when you are hit, and maybe the expiration of the option is the day after the announcement of the earnings, there's not much you can do about it. There's no defense. So especially when the expiration of the trade is very close to the date of the announcement of the earnings, I don't like very much to take non-directional trades like these ones. My favorite ones are the short puts, because at least I have a plan B. If the trade doesn't go well, and I believe that it could not be a problem to be assigned of the stock, so purchase the stock, be assigned, okay? When you short sell a put, you are selling someone else the right to sell to you the underlying. So if the price goes down, your counterparty will exercise this right, and you will be forced to buy the underlying. But if you don't mind taking the stock into your portfolio, then you can manage it. You can short sell calls, covered calls against the possession of the stock. So you can try and do, recovery strategies. But when you have a call credit spread or a put credit spread or an iron condor that gets fully overpassed by the price movement, you have no defense. There's nothing you can do about it. So I'd rather short sell puts instead of taking put credit spreads. Okay, so this is my first very general rule. If I can, I prefer short selling puts, but I do it when the value of the contract is not too high, like in this case. A put strike 80 means if I get assigned, it's $8,000 in one single shot, which for my personal portfolio it is not unbearable, but it is not something I would rather have. So I would rather have smaller positions if it's possible. So in a situation like this, I would give up to the chance to, just short selling puts and switch to credit put spreads, so that at most my risk is limited. Then the next step is to, aside of the probabilistic readings, I usually go inspect, as I showed you last week, if I'm not mistaken, the average positioning of the big movements, the big open interests, even if sometimes you get it wrong, because if I'm not mistaken, I told you about Walgreen Boots Alliance in the last live seminar, and my analysis turned out to be wrong, because it all seemed that the institutionals were expecting more an up movement than a down movement. But on the announcement of earnings, the stock dropped at 25%. So it was completely wrong. It happens, okay? It's part of the game. What you just need is always to have the chance to fix the mistakes that you inevitably make sometimes. So I look at the trade. I go inspect the average positioning of the institutionals in order to inspect whether the trade could be coherent with those positioning or not. Then something I think could be a good filter for the trades. I am still studying. Okay, I'm collecting data and then recording what happens on the expirations and check whether some filtering ideas that I came up with could give proof of being efficient. Okay, one of these ideas is when the expected profit and loss is at least a high fraction of the maximum potential one. Because when the let me try and find, okay, a case like this, the maximum profit is 0.85, but the expected profit is only 28. Aside of the fact that there are two probabilistic readings which are negative, but let's assume that they were all positive, okay? Aside the fact that here we have 0.02, 0.10, okay, so some readings are very low, even if they are positive. But the point is that the expected profit and loss here is just a fraction of the credit you collect in creating the trade. I don't like very much this kind of situations. I'd rather have a situation where the expected profit and loss, which is an average of all the expectations based on all the probabilistic models, is as much similar to the maximum potential profit as possible. Okay, that's my idea of the ideal trade, the ideal situations which I would rather be looking for in taking my trades. So this is my answer to the question: how do you eventually filter the trades? Okay, so let's move on. I could show you some other situations like there's a very peculiar situation I wanted to show you in the expensive options. I have been checking this one, yeah, PCRX, Pacira Biosciences, with all the limitations due to the fact that pharmaceuticals company are usually very volatile. And so sometimes the probabilistic reading are very good, but when a stock is very volatile, the distribution of returns is very wide, and the statistical significance of the historical analysis is lower than the one you can have on stocks that are more normal in their historical behavior. So you have to be very careful. Nevertheless, look at this trade here, the short put 15, expiration August the 16th, having a maximum potential profit of 0.75, success rate 98%, expected profit and loss 0.71. That's exactly what I was talking about a few minutes ago. Expected profit and loss in line as much as possible with the maximum potential profit. That's, in my opinion, the ideal situation, okay? Because it means that more or less all the probabilistic readings are saying the same thing, which very likely will be the outcome of the trade. And in a situation like this, if you believe in the stock, and then you could do all the reasonings you want, you could look at the balance sheet, you could look at technical analysis indicators, you could look to whatever you want. But aside of this, if you believe in the stock, the idea of taking the risk of being assigned for $15 per share could not be so bad, okay? Because maybe even after the announcement of earnings, which will be on August the 7th, the stock will significantly drop. But if the balance sheet is good, who knows, maybe it will recover. So it could not be so bad to be assigned of 100 shares, or maybe you sell 10 puts and you get assigned of 1,000 shares, okay, for $15 each. Speaking of fundamental analysis, if you hover the cursor here, you can see you have all the main fundamental data, which can help you in taking your decisions. For instance, one parameter I find very useful is the price to tangible book, because the price to book tells you how many times the price is reflecting the whole value of the company. But in the book value, there are often patents and expectations of future value of products and the like. The price to tangible book gives you an idea of what is the real value of the company or the real value of the book. And so how many times the current price is capitalizing the real value, the tangible book value of the company. And this, I can tell you, is an indicator, the price to tangible book, you don't find very frequently in the platforms that provide you fundamental analysis data. So I find it very useful. Then what else? I think it's time to move on to the Options Analyzer Pro, because there's a lot of things to say about it. First, the Options Analyzer Pro incorporates several different sections of the platform. First of all, the trading ideas. So the options trading ideas are included in the Options Analyzer Pro. Then you have the Build Your Own section, which allows you to create the trades on the option chains and get the full probabilistic evaluation and look at all the charts. And let me show you. You also have, let's take the stock suggested here, which it's not important. You have the options overview report, which I already showed you last time for all the expirations. You have the average strike, which is the weighted average of the strike prices using the open interest as weights. So it's some center of gravity of the main positions created by institutions, because somebody like me is not buying or selling 2,298 calls, but institutions are. And they, knowing that institutions are sometimes wrong as anybody else, but they usually have a better access to information. They have better means to analyze data and the like. So they are more likely to be right than me. So in trying to understand what they are doing could be a good starting point in order to try and take the best trades you could possibly take. So this helps you, this information, the average strike, helps you in understanding what they might be thinking, even if sometimes, as it happened on WBA last week, you get it completely wrong, but you also sometimes get it very right, as it happened on Nike. I don't remember if I showed you the example of Nike. I did it for sure in a video, in another video, which I published on the site, tradearplatform.com, because on Nike, the expectation of the institutions was quite clearly that the stock could drop significantly. In fact, the average strike on the put side was around 85, 83, 82, 86, and the stock dropped to 75 immediately after the announcing of the earnings. It lost 24, 25% in a single day, if I'm not mistaken. So they were right in being in taking very precautionary positions, and they were even not enough precautionary, because the stock went $10 below the average positioning of the institutions. So, it helps you at least in trying not to be on the wrong side of the market, okay? Even if sometimes you're not on the right one. But, in case of WBA, for instance, I decided not to follow the indications of the platform, which was suggesting credit call spreads, which would have ended profitable, okay? But sometimes it is better not to get profit than to risk to get a significant loss, okay? At least this is my personal opinion. Anyway, what can you make of the Options Analyzer Pro? On one hand, you have the Build Your Own section, which allows you to create all the trades you want to simulate and get the full trade analysis under all the probabilistic models. So you can try and find the best compromise between getting far from the current price, having a quite good expected profit with a quite high probability. But you can also take advantage of the time machine, which allows you to go back to 2006. And one of the most interesting ideas here is, let me switch to Tesla, just to give you an idea. I was looking for a good example. Before you see, I opened the chart on Yahoo Finance. And one idea, let's say that on March the 15th, on the expiration of March, with the stock trending down, you thought that maybe a bottom could be reached. So you decided to short sell a put, okay, expiration on June. So the first problem is, okay, I decided the time frame. What could be a good compromise in terms of a strike price far enough from the current price so to be in a, in a quite safe position, collecting a good premium in between. Okay, what happened here? Is this real or is it a mistake? I hope it's a mistake in the platform because the price dropped to 164. It was a flash crash, or at least it seems, in the after hours, because as I already told you, the market is closed now. Anyway, so the idea is on March the 15th to take a trade, short put, expiration June. Okay, what could be the best choice to take? Let's go back to March. No, I went too much back in time. Okay, January, February, March. Here we go. March the 15th, Tesla. Let's take all the available strike prices. Let's take the expiration of June. Here we go, June the 21st, 2024, 98 calendar days. So 163.57, the current price of the stock. Let's say that you could take into consideration, I don't know, the idea of short selling a put 130, okay, in order to stay $33 below, which is at 20%, more or less, okay. After a trend, a stock being already trending down significantly, so it's another minus 20, okay. So short sell a put 130, collecting 440, analyze trade. Here we go. You see the probabilistic readings, 89, 94, 60, 88, 49, the long stress test probability. You remember, if you remember what I told you last time, never fight the stress test probability. So let's try something else. Let's try and pick a better strike price. I don't know, 110, sell, collecting 172. Not much better, just 63. Anyway, let's stay with it, okay? Let's say, okay, I don't mind the long stress test probability. I want to take the trade. What can you make of the time machine aside of this? Because this already allows you to inspect, I don't know, in regard, just to say, in regard to all the trades you took in the past, what would have been the probabilistic readings coming with all the trades you took in the past, just to, have an idea of how much the probability readings were in your favor or against you. And you could, in retrospection, I don't know if I say it right, you could inspect whether, according to the probabilistic readings, the results were in line with the expectation based on the probabilistic readings. But you can do much more than that. If you go to the chart, you click on the button chart here, and you pick the last entry in the menu, backtest analysis with probability. You have all the evolution of the trade and the evolution of the probabilistic readings, which could help you in trying and find the best managing of your open trades. For instance, you could say, instead of applying a stop loss based on the chart or on any other indicators and whatever, you could say, should at any time the probability readings get below some threshold you decide on your own, then it could be better to think of closing the trade or maybe rolling it over, okay, or do something else. I don't know, include another option in order to reduce the risk, whatever, okay. So this helps you in trying to find the best management policies of your trades. And this is a very, very interesting function. Another very interesting function of the Options Analyzer Pro is the call probability matrix. Assuming that you have a stock portfolio or an ETF portfolio or a combination of a stock and ETF portfolio, which you want to keep, okay? Let's say you are creating recurrent purchasing plan, whatever, okay? Or you have a portfolio of stocks which you believe will multiply by 5 times, 10 times over the next 10 years, okay? But you are trying to create some cash flows, additional cash flows on these companies, aside of the dividends they might be paying, okay? And the answer is covered call writing, okay? But how? Because covered call writing, okay, you sell calls against the stocks you have in your portfolio. If things go well, you have a cash flow, but if things go wrong and the stock goes up like a rocket, you will be forced to sell the stock for a much lower price than the current one. So it would not be good at all. But the idea could be to take advantage of the probabilistic models of the platform and try and understand whether you could find the best compromise between the amount of the cash flow you can generate in short selling the calls and having at the same time the highest probabilities you can have not to be reached, so to keep the underlyings in your portfolio. That's what the call probability matrix is for. So the idea is you could either pick out of the money or in the money or any kind of options. But if you want to keep them, if you want to keep the stocks in your portfolio, you would pick the out of the money. You would pick the in the money if you want to get rid of the shares. If you want to try and find the best call to sell in order to maximize the return and have a very high probability to be assigned, so to get rid of the stock. So two very different targets, two very different goals in the choices. In this case, we're looking for the best calls to sell in order to have a good return and a very high probability to be not assigned, so to keep the stock in the portfolio. So we will pick out of the money options. You could either select the monthly or the weekly or all the types of options with a minimum bid price, okay, a minimum probability not reaching, let's take 75, I don't know, and with an annualized yield minimum of 3 and maximum 25. These are the default settings. A maximum annualized yield is made to prevent to go inspect opportunities which are most of the times based on mispricings in the chain. So if you aim to get too much high expected return, you would very likely end up with trades that you cannot actually take because they are based on mispricings in the chains. So it's better to stay even with a 15%, okay, as a maximum potential return, or a 20 at most. So search, let's see if we can find anything. Sometimes it's empty. Let's see what we can get. Oh, okay, very good. So expiration March 22. Sorry, I didn't get back to the real time. That's why I got puzzled by the expirations. Let's hope we can find something good in the current days. Okay, so for July the 5th, 2 days to expiration, strike price to 270, with the bid and ask 0.18, 0.19, the mid price, the percentage, ITM or OTM. This means how much the price needs to increase or decrease if you're switching to the in the money options to reach the strike price. What is the yield to strike? The value of the mid price, I think it's considered here, in comparison to the strike price. Okay, what is the annual yield? Because even if you are collecting only 7 cents of a dollar per share, if you calculate 0.07 divided by 0.90, this is the yield to strike. If you calculate 0.19 divided to 1070, times 365 days divided by 2, it makes 13.42 annual yield, okay, the annualized yield. What is the yield rate? It's the annual yield weighted on the probability rate, which is the weighted average of all the probabilistic readings according to the old models. So aside of this case, which is a very poor trade, let's look, for instance, to the second one. On July the 12th, 9 days from today, in short selling, a call which provides a gain of $1.20, okay, so it's $120 more or less, with the price of the stock that needs to increase at 15.67% to reach the strike price, a 0.42 yield to strike, which means an 18.25 annualized rate of return, which weighted on the average probability of success means a 16.61%. So you see, this helps you find the best compromise in terms of the annual yield and the probability not to be reached, which would mean to have the obligation to sell down the line, which you are not willing to do, okay, which you would like to prevent, okay. So this is a very interesting function for those who are keeping stocks in portfolios for months and years, and they're seeking for an additional return on that portfolio. What else? Let me think. I would like to also to give answer to another very interesting question that came to me by email yesterday. What is the minimum probability reading you want for all the models to reach in order to take the trades you take? Okay, generally speaking, I would rather have all the readings at least 90%, okay? But a couple of years ago, maybe 1.5 years ago, I decided to go inspect a thing, because I wondered what happens when all the readings are 100%. Because, you know, let's switch back to the build your own section, and let's go seek for the situation where we have all the readings at least 100%, if we can find it. Let's take a short-term expiration, you know, a couple of weeks. The stock now is 246.39. So let's say, what if I short sold a put, I don't know, a minus 30%, which would mean $65 below 180. Okay, here the gain is very poor, 0.18, but the odds in my favor should be very high. Yeah, you see, all the readings are 100%. Does it lose? Of course not. So my question that I asked myself was, what happens actually when all the readings are 100%? What is the empirical probability of success, the real probability of success? Because by definition, it cannot be 100%. So I decided to do a study, which I'm going to show you now. You see, I inspected 6 stocks so far: Coca-Cola, IBM, Merck, Intel Corporation, Unilever, and Verizon, I don't know how to read it. My question was, in the beginning, what happens when all the readings are at least 100%? But in taking the study, I also decided to inspect other thresholds, such as the 60%, the 75%, and the 90%. Okay, so when all the readings are at least a 60%, a 75%, a 90%, or 100%, what happens? That was the question. And here you have the results. Okay, on Coca-Cola, with 51 trades, I inspected the quarterly trades. Okay, so every quarter, I decided to open trade, a naked put with a strike price having at least all the probabilistic readings above some threshold, 60%. Look at the first line. The percent win, 44. The number of win, 44. So the percent profitable was 86.3%. So look at the difference between theory and practice. In theory, the probability to win should have been 60%, more or less. Okay. In practice, it was 86%. So the readings in the platform are precautionary in respect to the real ones, the real rate of success. Net profit, 6,800. Average trade, 133 per trade. Average positive, 272. Average negative, minus 738. The best, 846. The worst, minus 3,392. Okay, there's always a trade-off between, the probability of success, the average trade, the best profit, and the worst loss you might ever face. Profit factor, sum of all the profits divided by the absolute value of the sum of all the losses, the total number of days analyzed, and the analyzed return on investment based on what? Based on an initial margin assumed to be a half of the value of the position. So in selling a put 100, just to say, I would take into consideration an initial margin equal to 5,000, which is a very precautionary measurement of the initial margin, especially on stocks so highly capitalized as Coca-Cola, IBM, Merck, and the like. Okay, so this is a very precautionary. And I know that these returns are not very interesting, okay, but aside of that, my goal was to try and find the best compromise, okay, in having the best probability readings and having the best results in terms of the profit factor mainly, and the average trade, because you can see if you pick the 100% threshold for all the probabilistic readings, you have a 98% real rate of success. Okay, the percent profitable is not 100%, is only a 98%. The net profit is $56.5 in total. So the average trade is 1.1. You don't even pay the commissions. So it's not worth it. Okay. Aside of any other reasonings with a so low average trade, it's not worth it. Anyway, look at other underlyings such as Verizon Comms, okay, which is by far the best one. Even with the threshold 75%, the empirical rate of success is 100%. You never lose. At least on the last 15 years, 18 years, I don't remember exactly how long was the time frame. 4,700 days. It's calendar days, of course. 4,750 divided by 365, it's 13 years. Okay. In 13 years, trading puts short sold on Verizon Comms, having all the probabilistic readings at least 75%, you would never lose. The average trade would be $215. The best 900, the worst plus 51. So even the worst case scenario would be a gain. Okay, with an average annualized return on investment based on a half of the value of the position in terms of initial margin of an 8.5%. Okay, so I try to combine all the stocks in a single portfolio and look at the equity lines. This is with the 60% minimum threshold and the minimum probability in favor. This is with the 75%. This is with the 90%, and this is with the 100%. And look at that. The worst drawdown ever comes with the best probability readings. Okay, this drawdown is by far the greatest one in respect to all the other choices you could take. You see? So all of this was just to try and find the best compromise between the minimum threshold in the probabilistic readings, the expectations in terms of returns, the real probability of success, which by here, aside of any other considerations, even if you take the 75%, it's 94% on Coca-Cola, 96% on IBM, 95% on Merck, 96% on Intel, 94% on Unilever, 100% on Verizon. Okay, so even the 75% is a very good threshold. Okay, and it's the one that exposes you, for sure, of course, to the risk of a worst case scenario. Okay, but it also provides you with the best results in terms of the annualized return on investment. So you have to, close your eyes and take the risk of being in a less safer position, because in the end the statistics will be on your side. Okay, so that's the answer to the question. What is the best choice in terms of the minimum probabilistic readings in order to get the best compromise between probability and average returns? Okay, so I think that's enough for now. To conclude, we presented not all the tools included in the platform Trade AI, but most of them. There are others. If you are an equity trader, stocks and ETFs, you might enjoy the stock analyzer, and especially the portfolio builder, which combines statistical parameters, fundamental parameters, technical analysis parameters, and allows you to create the best portfolios ever and to monitor them in time, compare them with the benchmark and the like. It's a very powerful instrument. Maybe, Samuel, we should think of another webinar dedicated to these instruments. Anyway, now a question you might have is, okay, how do I get into all this? Okay, there are basically 3 ways to step into the world of Trade AI. The first is, of course, you go and purchase one or more sections of the platform. Okay, you go to either the pages of the site Trade AI platform or the pages of maxim.com, and you follow the links you find behind the videos of descriptions of all the sections of the platform. You will be redirected to the site of Quote Media. Okay, so in advance you will be redirected to Quote Media, which is the owner of the platform and is the one who is selling it. Okay, so this is one way you purchase right away one or more sections of the platform. Or you could take advantage of a package we created, which is called Quick Start Package, which provides 2 weeks of full access to the platform with real-time data and 10 videos explaining all the functions of all the sections. Okay, and at the end of the period of 2 weeks of access to the full platform, you will have a live Q&A seminar with me and Vladimir. So you could ask all the questions you have, all the things you want, all the curiosities you might have. And the third way is, if you say, okay, I like it, I understand the value, but I don't have the time or the will to, every time go inspect all the trades suggested, inspect all the lists of trades suggested by the algorithms. Okay, could you help me with that? We created a service called Trading with Trade AI, which you find in the site tradeaiplatform.com, where you have. It's not an advisory service. Okay, you will never hear me say buy this, sell that. Okay, the goal is to provide you with those we think are the best trades highlighted by the platform, commented. Okay, so an idea, as I showed you on PCRX, according to the option trading ideas algorithms, in terms of expecting expensive options, there is this trade, which is a short standing of put 15 with this credit, with this probability of success, with this expected profit and loss. The balance sheet is very good. The weighted average of the strike prices where the institutions are positioning themselves looks coherent with this trade. So in my opinion, it could be a good idea. If I am taking some trades myself, I am telling you, on my personal account, I decided to do this. Then you take your own decisions. Okay, this is the goal of the service. So once again, it's not an advisory service. It's just trades commented with all the pros and cons. Of course, I don't have the crystal ball. I cannot predict the future. Sometimes I get it wrong, as it happened with WBA last week. But what matters is that in the long term, the equity line on average goes up. So that's the goal. So that's it. Samuel, do you want to add something?